Hello, my name is Frank Evans, former Vice President with one of the larger mortgage lending institutions in the United States. The reason I am talking to you today is regarding my concern for our recent mortgage fallout, and as a concerned citizen, there is a way to help homeowners in our failing economy, which I will expound on. There is a methodology to decreasing the amount of money necessary to shore up our economy in relation to the mortgage industry fallout we are experiencing. In a hypothetical situation, if a borrower purchased a home in 2007 for $740,000 and now the value is $540,000, Congress, in conjunction with mortgage lending institutions, should be able to allow relief to the homeowner by sanctioning federally approved appraisers responsible to Congress to appraise homes that are at risk of going into foreclosure to get the most accurate reading on what the current value is in today's housing market. After appraisal, Congress should allow up to 20% maximum depreciation to the homeowner. This in turn would provide an avenue for Congress and lenders to pass that depreciated value on to the homeowners. The homeowners would then be responsible for the newly appraised value at an adjusted price. In this example, it would be $592,000 amortized over 30 years. The monthly payment on the original loan amount of $740,000 is $4,619 per month, and that's at 6.38% interest rate. The monthly payment on the new appraised value of $592,000 would be $3,695 per month at 6.3% interest rate. The difference and savings to the homeowner is $923 per month. The above would most likely appeal to homeowners based on the decrease in monthly payment, the opportunity to stay in their homes, and the ability to better manage their monthly outlay. What effect would the new appraised value have on lending institutions? If we refer to the initial example where we are using a $740,000 purchase price amortized over 30 years, the total principal and interest for the original loan amount would be $1,662,861 at 6.38% interest rate. Total interest paid during that 30-year time frame would be $922,861. Fast forward, with the adjusted appraised value and new loan amount of $592,000 passed to the homeowner, total principal and interest amortized over 30 years would be $1,330,289, again at the same interest rate I just spoke about a few seconds ago. And the total interest paid would be $738,289. The difference to mortgage lending institution from a profit standpoint over a 30-year period would be $332,572 in comparison to the initial loan. The following are the parameters we will have to live with as it relates to the mortgage relief program. Homeowners will be able to sell property at the new appraised value, but they will not be able to benefit from appreciation. If and when the market turns around, for example, cash out from refinancing because they have chosen the mortgage relief program, whatever appreciation realized should go as reimbursement funds to the federal government if and when the homeowner sells the property. There should be a moratorium on mortgage relief program properties for 15 years where the borrower will not be able to benefit from appreciation. Again, using the example of cash out refinancing, equity lines of credit, and privately sponsored second trust deeds. 15 years should be sufficient due to proven analysis that homeowners sell and refinance or upgrade their properties within a 5 to 7 year period. Only certified homeowner occupied properties should qualify for the mortgage relief program. And if it is found that fraud is occurring, Congress should institute stiff fines and criminal convictions. Congress has the ability to make this process easy by approving a one-page document for trustor, which is the homeowner, beneficiary, which is the lending institution, and trustee, which is your escrow companies, title, or attorneys. Congress should also depreciate mortgages packaged and sold into the secondary market automatically by 20% in order not to lose all profitability and to maintain the viability of the secondary market at this time. Why would the above be advantageous to Congress, lender, and the borrower? Homeowners who are thinking about walking away from their property would reconsider for several reasons. The home has been adjusted to current market conditions. Homeowner will realize a lower payment, lower foreclosure results, and lowered amount of bailout money would have to be used for foreclosure scenarios. In some cases, there are borrowers who are walking away from their properties not due to financial stress, but due to the depreciated value of their properties. In those cases, borrowers are initially maintaining their credit, whether it's going out and buying new property at a lower price or applying and renting homes or apartments to ride out these difficult times. With the outline as explained, we have the ability to decrease this kind of activity with a viable plan in place. Why does the above make sense in relation to our economic recovery? There are approximately 70 million homeowners in the United States. Now, out of that 70 million, 7 million, which is 10%, make up our subprime market. Therefore, there is a possibility that 7 million foreclosures could happen based on current market conditions. With a restructuring methodology, instead of realizing 7 million foreclosures, that number could be reduced significantly. Having a structured mortgage relief program in place will help the economy from a position of strength with disposable income made available to homeowners, and they can begin to refuel the economy. I know the question will arise that every homeowner will want to take advantage of the mortgage relief program. I don't think that should be a concern based on structuring a program where the borrower would not be able to realize appreciation benefits for a 15-year period. Additionally, homeowners in good financial condition are more concerned about being homeowners for the long term and would want to be able to realize appreciation benefits when the market turns positive. I do not have access to how the bailout money funds are being doled out, but from a precursory position, it would seem our Congress would rather fund a mortgage relief program more so than a complete bailout of 7 million homes with an average estimated value across the United States of $300,000. Instead, taxpayers would be financing up to 20% per home, which is $66,000 times 7 million on the high end in a worst case scenario, providing a lower monthly payment to homeowners and stabilization of the mortgage industry and our economy. If a foreclosure does occur at lower appraised values, lending institutions will have the opportunity to move properties based on current market conditions at a faster turnaround time period as to not have an increase in inventory throughout the United States. Of course, every other aspect of our ailing economy will have to present a logical recovery plan that will benefit all parties concerned based on industry dynamics. If you think my message has merit, I would suggest and request that you call or write your congressman and share this video with him or her to have action take place quickly. $700 billion is more money than any one of us can count. Therefore, we have to make sure it is allocated properly to ensure our future as Americans. Should you have any questions, wish to reach me, you may email me at fe003@yahoo.com. I thank you for taking a few minutes of your time to listen to what I have to say.